Hello everyone. Today we're gonna talk about basic accounting. First, table of contents. First, we have types of financial statement. Second, debit and credit. Third, accounting equation. Then assets, liability, equity, and example. Types of financial statement. The first type of financial statement is the balance sheet. Balance sheet report show the financial position of a business as of the report date. The information is aggregated into the general classification of assets, liability, and equity in a specific time. Or in other words, the balance sheet provides a snapshot of a company owns and owes, as well as the amount invested by shareholders. This is the example of a company's balance sheet This is an example of company's balance sheet that have asset, liabilities, and equity. Second type of financial statement is the income statement. Income statement reveals the financial performance of an organization for the entire reporting period. It is like the summary of a business revenues and expenses over a period of time. Or in other words, it is like watching a clip of a video that has a beginning and has an end. And if we look carefully, it can tell us a story about that business. This is the example of income statement. And last, statement of cash flow. Statement of cash flow is a report that reveals the cash inflows and outflows that experienced by an organization during a reporting period. Statement of cash flow can be categorized under three different activities: operating, investing, and financing activities. This is the example of statement of cash flow.
Okay, next we're going to talk about debit and credit in accounting. So the first one is debit. Debit is an entry made on the left side of an account. It either increases an asset or expense account or decreases equity, liability, or revenue accounts. Types of accounts that are increased in debit are assets, dividends, expenses, and losses. Note, to decrease an account, you do the opposite of what was done to increase the account. For example, an asset account is increased in debit, therefore, it is decreased with a credit. Next, credit is an entry made on the right side of an account. It either increases equity, liability, or revenue accounts, the opposite of debit, or decreases an asset or expense account. Types of accounts that are increased in credit are gains, income, revenue, liability, and equity.
Now we move on to the balance sheet accounts and classifications, in which the general accounting rule is assets equals to liabilities plus shareholders' equity. Now first, assets can be classified into two types, current and fixed assets. Current assets are a company's assets that are expected to be converted to cash within 1 year of the date appearing in the company's balance sheet. It is usually the resources that a company needs to run its day-to-day operations and pay its expenses. Current asset accounts can include cash, accounts receivable, inventory, supplies, and prepaid expenses. While fixed assets or non-current assets are long-term assets that are not expected to turn to cash within 1 year of date, since it has a useful life of more than 1 year. Its accounts can include property, plant and equipment, or in short PP&E, intangible assets such as goodwill, equipment, and investments. Now the second one is liabilities. It also can be classified into two types, both current and non-current liabilities. Current liabilities are one which the entity expects to payoff within 1 year from the reporting date. Its account can include accounts payable, unearned revenue, interest payables, accrued expenses, or short-term loans. While non-current liabilities are liabilities which the entity expects to settle after 1 year from the reporting date. Its accounts can include long-term bank loans, debentures, bonds payable, long-term notes payable, and mortgage payables. And the last one is equity. It represents the shareholder stake in the company, of which what the business owes to its owners. It is also a reflection of the capital left in the business after assets of the entity are used to pay off any outstanding liabilities. Therefore, equity includes share capital, which is contributed by the shareholders along with any profits or surpluses retained in the entity. This is what the owners take home in the event of a liquidation of the entity, theoretically. This is the shareholders' equity section of the balance sheet, which is shown after the assets and liabilities. It can include the retained earnings and equity capital as shown.
Now, it's come to the exercise. Number 1. The answer is C, because the correct answer, debit, is increase in assets and decrease in liabilities. Therefore, other options are incorrect.
Number 2, the answer is D, because the A option, revenues should have a credit balance. The option B, retained earnings or equity should have credit balance. And option C, liabilities should have credit balance.
Now number 3, you can try to journalize the transaction. This is the problem. On September 1, shareholders invested 15,000 of cash in the corporation in exchange for a share of stock, and SoftByte purchased computer equipment for $7,000 cash. Now the answer is that firstly, cash is debited with the amount 15,000 because its normal position is in debit, and share capital ordinary in credit of the same amount, 15,000. The next journal is that the equipment is in debit since the SoftByte purchased the equipment for 7,000, and credit to cash because cash is paid out to purchase the equipment.
And the last problem, still journalize the transaction. The problem is on July 1st, Sai Company purchased a delivery truck costing 420,000. It pays 240,000 cash now and agrees to pay the remaining 180,000 on account. The solution should be debit in equipment for 420,000 and then credit in cash and account payable for 240,000 and 180,000 because the problem says it pays 240,000 cash now and agrees to pay the remaining 180,000 on account. Therefore, they have two credit accounts, which is cash and accounts payable.
Thank you for watching our explanation on basic accounting.